Stop watching today's ticker tape and look at March 9, 2009. The financial world was ending. The S&P 500 had collapsed to a terrifying 676 points following the Lehman Brothers disintegration. Panic was absolute. But Margaret, a schoolteacher with zero Wall Street connections, did the unthinkable. While her family screamed at her to hoard cash, she took her entire $50,000 house down payment and bought a simple S&P 500 index fund. She didn't time the bottom perfectly, she just bought when the fear index was redlining. That single decision turned $50,000 into approximately $590,000 today. Margaret wasn't lucky, she was historically literate. She understood that wealth isn't made when the sun is shining, it is made in the dark. This isn't just about one teacher. Margaret represents a massive, silent demographic shift. Between 2010 and 2024, the number of U.S. millionaire households nearly tripled, rocketing from 8.4 million to almost 24 million. The people who got rich weren't day traders or hedge fund managers. They were nurses, engineers, and teachers who bought assets while the media sold the apocalypse. But staring at that 2009 chart is useless unless you understand what is happening right now. We are living through a mathematically identical opportunity, but the mechanics are totally different. It is not a market crash this time. It is a convergence of forces known as the Great Wealth Transfer. According to data from Cerulli Associates, we are witnessing the movement of $124 trillion over the next 2 decades. That number is too big to comprehend, so let's break it down. That sum exceeds the entire annual economic output of the planet Earth. It is 5 times the current United States national debt. This is a capital tsunami that will reshape the global economy. Baby boomers, who currently control 52% of all U.S. wealth, totaling around $78 trillion, are beginning to pass this capital down. This isn't just inheritance, it is a liquidity injection into the markets. Generation X is set to receive $39 trillion, securing retirements that looked shaky just 5 years ago. Millennials will inherit $46 trillion right as they enter their peak earning and spending years. The hidden secret here is the velocity of money. When $124 trillion moves, it doesn't sit stagnant in savings accounts, it chases yield. It flows into real estate, it floods into equity markets, and it funds new businesses. This transfer acts exactly like the post-World War II economic boom that built the American middle class, but on a significantly larger scale. The cascading effects of this capital moving will inflate asset prices regardless of the underlying economy's health. You do not need to inherit a single dime to get rich from this. You simply need to own the assets that this wall of money is about to buy. The only way to lose is to sit on the sidelines while $124 trillion seeks a home. If you ignore this shift, you are making the same mistake as the people who sold in 2009. You are looking at the noise instead of the signal. Stop watching today's ticker tape. Stop waiting for the government to save the economy. Again, what is happening right now is not a bailout. It is a $124 trillion private capital injection, and it is 25 times larger than the entire pandemic relief effort combined. Most people are looking at the 2009 housing crash for a playbook, but that map is useless because the fuel source has changed. In 2009, we relied on printed stimulus checks. Today, we are witnessing the Great Wealth Transfer, a tsunami of capital moving from boomers to younger generations. But here is the brutal reality check. You are probably not going to get rich from an inheritance check. The math is unforgiving. 62% of this transferring wealth is locked inside the top 2% of ultra-high net worth households. If you are sitting around waiting for a windfall, you are already losing. The strategy is not to wait for the money to hit your account. It is to position yourself in the industries where that money is forced to flow. This capital is not just changing hands, it is violently changing direction. Bank of America recently confirmed that 72% of younger investors actively reject the traditional stock and bond portfolios their parents built. Trillions of dollars are about to pivot out of stagnant boomer blue chips, think steady dividends and oil giants, and flood into aggressive growth sectors. We are talking about a massive repricing of assets into artificial intelligence infrastructure like NVIDIA, clean energy grids, and digital assets. This is a sectoral rotation of biblical proportions, creating tailwinds for specific assets while leaving legacy portfolios in the dust. The divergence gets even wider in real estate. The market is about to experience a supply shock we haven't seen in decades. As boomers downsize, millions of large suburban and retirement homes will hit the market, potentially saturating demand in slower economies like Cleveland. Meanwhile, millennial capital is concentrating intensely in tech-focused hubs. The outcome of investing $500,000 in a depreciating Rust Belt suburb versus a high-velocity market like Austin will be catastrophic for those who ignore demographics. But the hardest part is not picking the sector. It is the psychological warfare of staying in it. Look at the data from 2009. Consider an investor named Margaret who started buying at the market bottom. She did not just ride a smooth line up. She survived the terror of the 2011 European debt crisis, the 2018 trade wars, and the violent 30% crash of the 2020 pandemic. It would have been easy to sell, but Goldman Sachs research proves that market timing is a wealth destroyer. If Margaret had panicked and missed just the 10 best trading days since 2009, her annual returns would have been slashed from 17% down to a mediocre 12%. That differential compounds into hundreds of thousands of dollars lost. The terrifying part is that the best market days historically happen within 2 weeks of the worst market days, right when fear is at its peak. You cannot capture the upside if you are not willing to endure the volatility, which is exactly why.
Stop waiting for the perfect market bottom, because it does not exist. While you sit on the sidelines praying for a crash, the mathematical certainty of the great wealth transfer is leaving you behind. Let's look at the raw numbers. If you are 35 years old and you invest just $500 a month into a diversified index fund for the next 25 years, the exact duration of this massive wealth shift, you aren't just saving pennies. Assuming a historical 10% return, your $150,000 in contributions explodes into $665,000. Scale that contribution to $1,000 a month, and you are sitting on a fortune of $1.33 million. This isn't magic. It is compound interest supercharged by macroeconomic tailwinds. As trillions in assets move hands, that capital velocity fuels GDP growth, pushing market returns even higher than the historical average. But passive investing is only half the battle. Strategy number 5 is capitalizing on the secondary boom. This transfer requires an army of professionals to facilitate the movement of money. We are seeing massive career and business eruptions in estate administration, tax advisory, and wealth management. In just 3 years, the share of Gen Z and Millennial clients at major wealth firms jumped from 8% to 25%. If you aren't positioning your career or business services here, you are missing the gold rush. Then there is Strategy 6, the spousal bridge. $54 trillion will move to surviving spouses first, with nearly $40 trillion going specifically to widowed women. This is creating an unprecedented, underserved market for financial services tailored specifically to female wealth controllers. So here is your definitive battle plan to execute immediately. First, you must maximize your tax-advantaged accounts. With the 2026 401k limit hitting $23,500, you need to fill that bucket completely to prevent tax drag from silently eroding your compounding power. Second, maintain relentless broad equity exposure through low-cost index funds. This ensures you capture the upside of every sector involved in this transfer without the risk of picking single losers. Third, build a dedicated cash sniper fund. You need ready liquidity to pounce on real estate or asset mispricings that inevitably happen during messy, volatile estate liquidations. Context is everything. We are standing at a precipice comparable to the industrial boom following the Civil War or the massive tech expansion of the 1980s. That era pushed the S&P 500 up nearly 3,000%, creating dynasties out of ordinary families who simply stayed in the market. History will look back on this 25-year window as the defining wealth creation event of the century. You no longer have the excuse of ignorance. Hit subscribe and like this video to signal to the algorithm that you are serious about building wealth, not just watching